Hello future homeowners, I'm John Werner with Mortgage and Credit Pro. Today we're talking about something that might sound a little confusing, but it's super important if you want to understand why mortgage rates go up and down. Who's the big player? It's something called the Federal Reserve, or just called the Fed. The Fed is the central bank of the United States. Its job is to help the economy by keeping prices stable and assisting people to find employment. When things become too expensive or too slow, the Fed intervenes to try to address the issue. The Fed has a special tool called the federal funds rate. This is the interest rate that banks use when they lend money to each other for a short amount of time. When the Fed changes this rate, it can affect how much it costs to borrow money, including for buying a home. The Fed doesn't set mortgage rates directly. However, when it raises or lowers its rate, it alters the cost of banks and investors to borrow money. That means mortgage rates usually move up or down as well. Investors often purchase Treasury bonds, which are considered very safe. If those bonds start paying more, then mortgage companies need to pay more too, so that investors will continue to buy. That's why mortgage rates often follow the 10-year Treasury yield. They move together. Let's talk about the different types of home loans. If you get a fixed rate, your mortgage rate stays the same the whole time. The Fed still has some effect on these rates, but it's a little slower. That's because fixed rates depend on long-term factors such as bond yields and inflation. But if you have an adjustable rate mortgage, your rate can change over time. These are more directly tied to the action of the Fed. So if the Fed raises its rate, your monthly payment may also increase. The Fed is a big part of the story, but it's not the only part. Mortgage rates can also fluctuate based on inflation. If prices rise too quickly, rates typically increase also. Jobs in the economy. When more people are working, they tend to buy more homes. They can make rates rise. Investor behavior. When many people want to invest in safe assets, such as bonds, mortgage rates can drop. An example, let's go back a few years in 2020 when the Fed significantly lowered rates due to the impact of COVID. Mortgage rates dropped to record lows. With some rates under 3%, many people were able to buy homes and save money. However, in 2022 and 23, inflation surged, promoting the Feds to raise rates to cool down the economy. Mortgage rates surged, and some even reached 7%. You can see how the Fed's choices can significantly impact the cost of buying a home. So what does this all mean to you? It means that understanding the Fed can help you make smarter choices. Whether you're buying now or later, knowing how the Fed affects mortgage rates can help you plan, save, and buy at the right time. If you're ready to take this first step or would like to learn more, get in touch with us at Mortgage and Credit Pro. We'll help you understand every part of the process. If you found this video helpful, please give it a thumbs up and hit that subscribe button so you never miss a tip. And if you're considering making an offer soon and need help running the numbers or getting pre-approved, please reach out to us at Mortgage and Credit Pro. We're here to help you buy with confidence. Thanks for watching, and we'll see you in the next video.